that's the unanswered question that we kind of enter 2022 with, 2023 with, is how do we resolve this imbalance between sentiment and positioning? Happy Thursday afternoon, everybody. Welcome to Townhall Takeaways. Willie Delwich here, where I try to every week discuss a few of the important topics that I see in the market, really distill it down to a few key takeaways of all the things that are talked about, all the charts that are shared, all the various topics that we could delve into. And the theme for this week, as we get going in 2023, is we're off to a fast start, a much faster start than we saw in last year. The question, though, is whether or not we're going to see investors really embrace the rally, really embrace the strength that we're already starting to see this year. If they do, then we can build on some of the strength that we've seen in the first couple trading days of January. If not, then even though we've had a fast start, some of those lingering concerns from 2022 could start to come back and start to haunt investors and really make for a tougher slog than I think a lot are hoping that we'll see this year. So let's get into it. I think the first way that we can think of, or a couple ways we can think about the fast start for 2023. S&P 500's up almost 4% already this year. Interestingly enough, while it's up 4%, it's actually lagging the rest of the world. ACWX is up almost, I think, 7% so far in January. The Eurozone's up 10%. So that 4% number for the S&P actually puts it in a lagging position relative to the rest of the world. That was a key theme that we started to see last year, continuing this year. So strength on an absolute basis, losing ground on a relative basis for the US. Another way we can think about a fast start is looking at new highs versus new lows. Talked a lot about it last year, how we weren't seeing very many trading days with more new highs and new lows. Total of, I think, 20 of them over the course of all of 2022, by far the fewest that we've seen in the past 50 plus years. Already this year, we're up to 7 days. So every day so far this year, we've seen more new highs and new lows. It took until August to get more than that last year. So starting the year with from a much better position, leading to some optimism about seeing some a new bull market, a shift in a sustainable trend. That's an encouraging development. So seeing that evidence of strength already in terms of price gains, but also more importantly, seeing it in terms of more stocks making new highs than new lows already, where it took us 8 months to get to last year, we're at in 7 trading days this year. The question as we go forward in terms of whether or not this is sustainable, or this is another one of those bounces like we saw last year, is whether or not investors embrace this rally. That seems counterintuitive. Everyone wants to be a contrarian when it comes from a sentiment perspective. You see an uptick in optimism, you say you got to sell, down tick in pessimism, or expanding pessimism and say you want to buy. Sentiment doesn't work that way over time. It works at extremes, but after extremes, you want to actually lean in favor of that trend. And right now, after seeing extreme pessimism last year, if this bull market is going to have, if this rally is going to turn into a bull market, if the rally is going to have legs and be sustainable, it's got to bring in optimism. That is the lesson as we look out over the past decade at what the S&P has done relative to the Investors Intelligence bull bear spread. We got up to nearly 20 on the bull bear spread, so 20% more bulls than bears. In August, that was the high this time around. That coincides with the high that we saw in the 2015, 2016 sell-off. There, you got up to 20. That's when the S&P stopped rallying and actually made a lower low. Later in 2016, you got above that level. That opened the floodgates for optimism and sustained strength, leading into that decline towards the end of 2018, first part kind of lingered a bit into 2019. There too, you saw a drop in the bull bear spread below 20%. That's where the weakness was really intense. Got up back above it. You rallied into the pre-COVID highs. Again, pessimism expanded. got below 20%. Stock struggled, you get above 20%, and you see sustained rally into last year's high in the S&P 500. Since then, we've been below that 20% threshold for the bull bear spread. If we're going to see the strength that we've seen so far this year build on itself and be sustainable and actually turn into a bull market, we're going to have bulls come along for the ride. Just not enough optimism in this environment to suggest that we could get sustained strength. And then that leads a kind of a retrospective from a sentiment and positioning perspective for last year and what that might mean for this year. We draw a dot plot between the Michigan Consumer Sentiment Index and on one axis, and the equity exposure from AAII Asset Allocation Survey perspective on the vertical axis. And you see there's a pretty strong relationship over time between sentiment and positioning. When people are optimistic, they tend to have a lot of equity exposure. When they're pessimistic, they tend to not have very much equity exposure. Started to see an aberration in that trend in 2021. You started to see sentiment move south. You didn't see much from a change in equity exposure. You did see a change in equity exposure over the course of 2022, but you also saw an even more dramatic decline in sentiment that year as well. And so the question is, for as we go forward, is how do we get that historically normal relationship back in gear where sentiment and positioning are moving together, not at odds? So the question is, do we see equity exposure contract to match where sentiment currently is, or do we see sentiment expand to get to where equity exposure currently is? Go back to what we're seeing from a sentiment perspective in the weekly data. If we don't get an expansion in optimism in the weekly data, my guess is then you start to see equity exposure drawn down from a longer term perspective and start to match where investors are kind of emotionally living right now. If we do get some of that shorter term optimism and prices sustain some strength this year, then you solve this the other way. You see sentiment recover, equity exposure staying high and moving back to where they historically have been. So that's the unanswered question that we kind of enter 2022 with, or 2023 with, is how do we resolve this imbalance between sentiment and positioning? If we don't see some short-term optimism and see that investors embrace the strength we've already seen this year, then it likely leads to bringing down of equity exposure and starting to explore some other asset allocation opportunities, whether it's in the U.S., looking at bonds, looking at cash, looking at commodities, or globally diversifying. I think either way, that's probably long-term good for investors, long-term good for the market. But exactly how we resolve that we're going to have to see as we go through this year. So those are the takeaways. Strong start for this year, certainly encouraging, certainly different from last year. The question is whether or not investors will embrace that strength. And then if they do, whether or not we get some resolution to this imbalance that has emerged over the last couple of years between positioning and sentiment. So those are the takeaways. Thanks for tuning in. Do this every Thursday afternoon where we share some town hall takeaways, important topics that are key for as we're digesting and understanding what's happening in the market this week and as we go forward. Thanks for tuning in. Thanks for listening. Talk to you next week.